Thank you for tuning into the Alt Fund Investment Podcast. Please like and subscribe if you find this information helpful. We connect investment fund managers and service providers. This content is for informational purposes only. Today we're here with Joe Brennan of Houlihan Capital. Houlihan is a financial services firm. They provide valuations, investment banking, and some other services Joe will get into. But Joe, welcome and thanks for joining us today.
Appreciate it. Thanks for having me, Mike. Good to be here.
Tell us about Houlihan Capital and the services that you guys offer.
Yeah, so we're a traditional kind of valuation advisory firm. We also have an investment banking arm and litigation services. So I stick on the valuation side of things. We offer things, portfolio valuation, right? And there's enterprise valuations, opinions, gift and estate valuation services. So you run your gamut of valuation advisory consulting, and that's kind of where we provide the best services. I stick a lot with portfolio valuations, illiquid assets, and complex securities that are kind of related to or tangentially related to crypto assets.
Good stuff. Tell us what exactly does it mean to provide valuation services?
Yeah, that's a good question. I think for me, we really take a lot of the burden off of our clients when they are going through kind of some other strenuous activities, right, that are required, namely an audit. So a lot of times our clients are very skilled at making the investments. They can see where the market might be going, why this investment fits in specifically, and have a vision for the future. But the challenge becomes trying to mark those assets up to fair value on frequent periodic basis. And so that's kind of where we come in, right? The audits needs to be done every year. And their net asset values for these funds need to be marked. It's an open-ended fund on a more continuous basis. It could be closed-end. There's a little bit less risk involved there, but the GAAP still requires these assets to be at fair value. So that's where we come in. We kind of take a look at the portfolio. We work with our clients directly that are in tandem working with their portfolio companies to try to come up with a reasonable valuation for their audits. And that's kind of the process and why we take a lot of headache off from these clients, right? I mean, we kind of go above and beyond and work directly with the auditors to answer the questions. We have experience doing so. We kind of know what they're asking, right? I guess I personally was sitting on the other side of that aisle asking those questions. So I kind of have a general sense of what's coming. And so it's helpful for our clients to kind of get that experience.
Got it. And you mentioned a couple of different things there. So you mentioned like illiquid assets. What type of illiquid assets require, these type of valuation services? Is it private stock, real estate? What kind of walk us through what that looks like?
Yeah, so we primarily focus on investments in other companies and those types of investments. I think there are other, real estate, certainly hard assets. Those are more illiquid, but other valuation firms specialize in those. We are more on the kind of financial service side of investments. So again, yeah, like you said, investments in private on the digital asset side, your SAFs or simple agreement for future tokens. Okay. You've got your simple agreement for future equities, your safes, your safe Ts, run the gamut there. And so those types of investments are kind of what we focus on for a portfolio, essentially, of a hedge fund or venture capital fund, right?
Makes sense.
Mm-hmm.
So walk us through the valuation of a company.
Yeah, so there are a couple of different approaches, right, that are generally accepted in the industry, 3 to be specific. So there's the asset approach. It depends, but might be one of the least used ones, I guess. Depends on the asset, but you're talking adjusted net asset value. So you're essentially using a balance sheet approach and adjusting given line items on there over time based on certain factors. The market approach is probably the most common, I would say, in especially in kind of crypto or more private illiquid digital asset stuff. You have your public comps, your transactions, your comparable transactions, where you can kind of try to mark your subject company's assets and the financials from your subject company to a given market. Are comparable. And then you have your income approach, right? And that's the DCF, capitalized cash flow. Those are a little bit more challenging in this space and private company space in general, just given the information asymmetry and kind of sometimes the lack of information that even clients or investors have in these companies. And so that's kind of what makes the industry seem opaque, and sometimes it can be that way, right? But I would, the market approach is kind of the most used and kind of most relevant, perhaps, in some of these markets.
How does your team look at the valuation of tokens? Some people say there's no, intrinsic value. How do you guys look at that when it comes to Bitcoin, Ethereum, or kind of any other really layer one, or
Yeah.
any token that's not a security per se?
Yeah. So I might have a little bit of a cop out here, given the fact that based on kind of mostly what we do, portfolio valuation work, the market approach for liquid tokens is generally the best approach. And so as of a given date, many times that's the best fair value estimate on that date, right? So there are benefits to looking in the past, I suppose, and instead of trying to project or predict given liquid. It's similar akin, right, to what an auditor would say the value of Apple is on a given date, right? Sure, you could come up with your own market, your own price, your own intrinsic value, your own DCF, your own model, but it's also much easier to simply take a level one approach. And we can get in kind of the ASC 820 hierarchy if we want, but level one being a direct market input from a reliable source. And so an exchange, for example, right? So you look to NASDAQ and then say that Apple is trading at a certain price on that date. Okay, that's what the fair value is, right? How many
Makes
shares?
sense. Something publicly traded, easy to get
Right,
that price.
exactly. So Bitcoin, Ethereum, these are very liquid crypto assets. They're being exchanged a lot of times in a given day. And so you look at that. There are some considerations potentially for other tokens who aren't trading as much, right? So there could be some liquidity concerns there. But I think it's an easy cop out, right? Prices on a given date is kind of what we look at. But I mean, I think there are ways like frameworks you can put in place, right? Like now, any layer one or some DeFi protocols, right? You can look at things like annualized revenue of the protocol per user, perhaps. I mean, an inflation rate. How much is the protocol subsidizing other holders of these tokens to encourage them to use their services? Things like total value locked, if you really wanted to go that route. Obviously, that's influenced perhaps by the dollar value of a given token at a given time. Unique address count, hub commits, right? Developer activity, that's certainly a big one if you're trying to kind of predict that thing. But, for the most part, we have it relatively easy in terms of the liquid tokens and in saying that the price is what it was on that date for auditing purposes. It's tough. We haven't gone the route of trying to come up with our own value yet. Certainly, I've done that on my own, but to an extent, we'll see if it's successful yet.
Good stuff. Tell us about, because you touched on that a little bit. I'd like to dive in a little bit more. Tell us about level 1, 2, 3 assets. What are level? I guess if you want to just cover them all real quickly.
Sure, yeah. So the ASC 20 hierarchy, it's under US GAAP audited financials. They're required to kind of categorize their investments, and this is generally for investment company in that framework. So level 1, as I mentioned, unadjusted quoted market prices in active markets for identical assets or liabilities. And so that's essentially pulling prices again from NASDAQ or pulling prices directly from the exchange. So you kind of have, there's some nuances involved in crypto, right? What is your principal market? You can kind of try to define that, but a level 1 price would be something if, for example, you have an account Coinbase and you're a fund and you're trading on Coinbase, that's your exchange. So what is the price of Ethereum on that date from Coinbase, right? So you kind of pull the API directly from them. Level 2, there's three levels here. Level 2 would be inputs kind of that are other than those direct quoted market prices. Either directly or indirectly, they're observable, right? So the concept revolves around the observable nature of these, but it's not a direct price. So this is a great example here in crypto where you're looking at kind of a volume weighted average price on CoinMarketCap or another aggregator, for example, where it's essentially pulling prices from multiple different exchanges based on the volume traded. And so CoinMarketCap is doing the job of kind of pulling those together and providing a cumulative volume weighted average price. That would be observable input, but it's not directly from the exchange that you'd be trading on, right? So that would be a level 2 asset. And level 3 is kind of the world that I operate in. These are investments that are being valued using unobservable inputs. And so this is noting, really at the end of the day, this is all to help guide a user of the financial statements where, they need to know, okay, what level of risk is involved in these assets and the valuation. Level 3 obviously is the highest risk because it involves the most observable assumptions that are being made by the management team. And so these are inputs they might, and general users of these financial statements, they might not have access to the company's management team, right? And so things like that, conversations with the management team, management projections, their own assessment of the company's projections or future prospects that are being included in their own kind of intrinsic valuation model. They're taking a stab at trying to come up with the value, right? And so that's kind of why they're bucketed there. And and notably more risky. And so when users of financial statements see a significant portion of their of a mutual fund, hedge fund, venture capital fund in level 3, they know that there are at least a lot of inputs that are unobservable to them that they're kind of relying on management to.
Yeah, that makes a lot of sense. Now, when it comes to like you kind of talked about how Bitcoin could be considered a level 1 or 2, depending on kind of how you look at it. How are funds typically, valuing it if it's not too general of a question?
Yeah, in terms of the hierarchy structure. Yeah.
Yes. So I mean, you're working with fund XYZ. Are you guys just going, okay, you guys trade on Coinbase, so we're going to use Coinbase price, or is
It's a
it
good
usually
question.
more of the aggregation?
Usually that is a kind of a decision they make directly with the fund administrator, and how the classification is determined ultimately relies on the auditors sign off as well too. So I would say that from our perspective, we aren't really involved in kind of the liquid stuff or the categorization of stuff. I will say, and things change in this industry, right? I think that what is going on right now might not have been going on 5 years ago. Certainly, I think it really just depends on kind of the level of precision that a fund wants, what their manager is typically used to, right? I mean, we're seeing an overflow of more traditional asset managers that are now coming into the crypto space, right? Kind of dipping their feet and trying to get into this new space. But they have these kind of tendencies from TradFi, if you will, that have been in place for a long time. And so they're used to pulling API scripts directly from exchanges, right? And so they might try to go that route. And it's really, it certainly depends on kind of their comfortability. But I'd say I'd probably, for ease, for sake of efficiency, using a level 2 at CoinMarketCap might be a route to take. But again, there are some things that you're offloading in terms of the due diligence that CoinMarketCap does, right, or CoinGecko or what have you, that they're trying to sift out wash trading. They're trying to look at, they give those exchange scores. And so there might be some underlying risk there that you're not really expecting. So maybe the best route to tidy things up is to go level 1 directly from the API. It just depends on kind of your level of expertise and technicality.
That's great. Thanks for diving into that with us. NFTs, got to touch on them a little bit here. Talk to us about NFTs.
That's JPEGs, of course.
How do you value them?
Very good question. This is something that's kind of on top of mind for me as well, both personally and professionally. I think we have clients that are now involved, and certainly from fund level, no doubt about it. The funds have come to an extent. To what extent is certainly the question, but there are investments in NFTs that have become materially being parts of portfolios for clients, right? So as you said, I mean, it's a difficult process, right? I mean, there are things that kind of haven't yet been solved in terms of how do you consider wash trading, perhaps, things, other considerations that might not be as known, the floor price being manipulated, right? I mean, I think the initial way that I view things from the NFT perspective is, again, kind of under that market approach framework, where yes, there are unit of account issues where I've heard arguments that certainly they are one for one, where one is not the same as the other. And so can you use a floor price, for example, for an entire fleet or apes, or are each one of them needing to be considered separately? I think you can make an argument either way. But for me, it really comes down to more of a market approach. You have to look at actual historical transactions, because anybody can potentially sweep the floor of a collection and then just raise them high and say that that's the price, right? But truly, it's not based on.
That's a really good point, because that could, especially when it comes time to make the marks, there could be like key dates they're looking for.
Exactly. I mean, and you've seen that in other markets potentially too, where it's a liquid, right? And so you want to try to snatch that up and mark up basically it's not a real value, right? And so I think from my perspective, you want to see what actually people are paying for these things, and the price that it's being transacted at, right? Because it's not that exit price. You want to find the price that a willing buyer is able to make. And so that's where the price changes hands. The challenge, of course, becomes how do you consider rare traits for certain collections that might not be trading as much? We've seen explosion of kind of NFT fi, if you will, this summer of experiments that are happening right now. So I'm very interested to see how those play out. I think that using some of those involved in an NFT valuation kind of framework is what we are doing, what we're trying to do, and using that kind of our expertise in traditional valuation techniques, kind of market approach and being aware of what's going on and things to look out for is very helpful in this.
It's been some recent changes by FASB, and FASB is the Financial Accounting Standards Board, around the valuation, particularly for fair value measurements. Can you talk us through what some of these changes are?
Yeah, sure. So FASB 2022, I think '03 is what you're referring to. The earlier this summer it passed. It was primarily around the concept of contractual restrictions, sale restrictions. So it made a couple unusual changes. Equity securities was defined a little bit differently. Some changes to the code, but one of the major changes revolved around asset specific restrictions versus entity specific restrictions. So essentially, what they're trying to do here, the high level goal, I think, is good, right? They're trying to make it easy for users of the financial statements to understand what the true fair value is, make it easy on the administrators and the fund the management to provide a fair value estimate, making it uniform, right? So there were some differences in what one investment advisor was estimating for a discount versus another based on some of the assumptions that they made. So they're trying to make it more uniform. However, I think that some of the changes they made could lead, to some disastrous results. Certainly, if applied, I think in the crypto space. So it's a tough thing, right? I mean, I think so. The concept again of asset specific restrictions versus entity specific restrictions. So the entity specific restrictions are still in place. Those would be though things like you can't. Again, we're talking about equity securities here. So those would be things where you are an asset where you can't actually trade on a national securities exchange, right? So that is an asset specific restriction, right?
Yeah, just to separate those. So asset would be real estate, bar gold. Whereas
right. So the asset itself, right? We're talking about in for example here, a share of private stock, and so that you aren't, if for example that's not being allowed to be traded in a given country, then that particular security, it's an equity security with an asset specific restriction. And so in that case, you do need to take into account the contractual sale obligation and estimated discount for lack of marketability. In the other case, right, an entity specific restriction. Say I buy something from you, Mike. I buy an asset from you. This is again an equity security. So we're only talking about equity securities. But I buy shares of company XYZ, which is a private company that you own. You own certain shares, and I buy those from you. That we agree that I won't sell these for 6 months. So when that is considered an entity specific restriction. That restriction is only my restriction in place, right? No other buyer potentially of that XYZ company has that restriction in place, right? So you could sell those shares to someone else, right? And so they are saying that restriction should not be considered. Now, of course, the counter argument to that would be that there's still a real restriction based on the sale, right? You still can't sell that restriction. There's still time that needs to go by before you can actually realize any gain or loss, I suppose, on that transaction. And there is a material discount to that asset, that equity security, that in my mind is real. And so that's kind of where they're coming. They're trying to make it uniform, but I think that the challenge and some of the difficulty is that there might be people who are buying in and out of these funds at a certain price that they the fund actually can't receive if it were to belly up and need to sell its securities, right, its investments. And so there are these concepts that are happening in this pronouncement that to me are a little bit thing, I guess. But
talk to us about the ramifications. So what are kind of the implications of a rule like this?
Yeah, I think it takes some complexity out of the process, right? And so I think that was and adds uniformity. That's at least the goal, right? These funded advisors don't need to come up with their own estimates for these discounts, which is nice. It's good for them, and certainly, I guess, it certainly removes some revenue from valuation service firms, right? But at the same, on the flip side, I think it truly hurts kind of potential investors in the sense that they might not be getting in at kind of that fair value. I mean, the discounts can range anywhere from in the private company market 10 to 20% perhaps, but that's kind of where I see it being a challenge. I mean, from where I sit too, in the digital asset side is kind of where I see the biggest challenge or potential headwind for companies adopting this who crypto assets that are subject to restrictions, right? So that's a lot of what we do is kind of we help assess what the discount is on certain tokens that are still subject to vesting schedules, right? So when a hedge fund or a fund buys a SAF and that token launches, right, that SAF has certain metrics and parameters in it that say that they will get X amount of tokens for each month over the next 3 years, right? Once the protocol launches, or there'll be a cliff and then they'll receive in tranches, and it might be in 25% in 6 months, 25% in 18 months, etc. Now, what advisors would try to be doing if they were to apply this to those tokens would essentially be marking these tokens up to the market price right away when it launches. When, to me, a rational investor would not pay the same price for a token that's locked versus one that's immediately tradable. I mean, it doesn't make logical sense. The ability to have liquidity in that sense is significant, and it's worth something. It's worth the premium. Not to mention, I mean, I know there's been a ton of news, recent events, certainly about FTX and that collapse, but there was some news, and this is just speculation, but potentially some of the collateral that was posted by FTX had a value that was significantly higher than the total floating market cap of those protocols. And so, to me, that sniffed out pretty easily that SPF was marking those assets at full market value, almost, not considering a proper discount for lack of marketability. So this is analysis we do. It's a put option pricing model. It's very technical. It certainly depends on some assumptions based on the volatility of that asset, also a benchmark asset, including, it's kind of we use a put option pricing model. There are different put option pricing models that you can use that we've kind of honed in on. And so it's a challenge, it's certainly a little bit of a complex process, but it's something that I think that folks need to use. And once you have kind of the preliminary model in place, it's something that you can kind of update on a more timely basis. And to me, it's just the true value, I think, of what a locked token would be trading for.
Talk to us about a put option pricing model.
Yeah, so the most common is the Black-Scholes. It's a model involved that takes some certain inputs, time to maturity, the estimated annualized volatility, the rate, the risk-free rate, right, and then whether or not there's kind of a dividend on that underlying asset, which is typically zero in these cases. But it's a model that you take those inputs and you try to, from our perspective, you try to find the price of a protective put it's really based on kind of the length of time now and that unlock date, right? So we input that time to maturity is how long that vesting schedule is. And then it's a market approach. At the end of the day, we're using kind of the price as of a given measurement date and assessing what that estimated, you take kind of that put option pricing, that put option price, and then you divide it by essentially 1 to come up with a discount, an estimated discount. And so the concept in theory is what the price you'd need to pay to protect that investment on the downside for the length of time that you've selected. And so it's a technique that's taken from traditional finance and used in, again, kind of these contractual sale restrictions. So we mentioned that earlier. Other private company investments, you can use that kind of analysis to assess differences perhaps between private company shares and public company shares, certain pipes and the like. And so it's kind of borrowed again from traditional finance, and it's not something we reinvented, but there are nuances involved. The volatility we calculate, for example, I tend to gravitate towards using what is called a Rogers Satchel volatility instead of a close to close volatility, right? Where it kind of incorporates an open, high, low close price instead of just a close to close. I feel like in my years ago when I was learning as much as I could about volatility calcs, it kind of, to me, made the most sense given the 24/7 nature of crypto. Things like that are just a little bit nuanced that you might not see in traditional finance. And so, having that expertise in crypto has helped.
So just to kind of transition here a little bit in terms of like the fund space. So when you're working with the hedge fund, VC fund, what other service providers are you guys working with in terms of like audit, admin, and kind of what does that relationship look like? Because one of the things that comes to my mind is like, I would have assumed an auditor does a lot of, this type of work, but I'm curious to kind of understand how you guys work with these different service providers.
Yeah, so a lot of our referrals do, I think, come from auditors, and we work a lot directly with auditors because they know our work product, right? And at the end of the day, they are kind of doing a lot of this recalculation, perhaps, maybe doing it on their own or trying to come up with these techniques on their own and assessing things, right? Because they, at the end of the day, have to sign off on the audit. But from an independence perspective, they're not allowed to, say what the value is of their clients' portfolios, right? That would not be appropriate under those guidelines. And so they kind of reach out to companies like Houlihan Capital, where we can come in and work directly for the client, with the client to, assess what the value is and then provide it essentially to the auditor. So yeah, again, we take phone calls directly from auditors. We work with them directly to kind of answer their questions. Also, I think fund administrators as well. That's another service provider that we also work with. Basically, we're an extension in a sense of our clients and their valuation needs, whether that's on a monthly, quarterly, annual basis.
Good stuff. What advice do you want to give to a new fund manager?
Yeah, I would say get in touch certainly with your fund administrator, your valuation provider, your auditor, and build those relationships early. I might think that valuation and almost similar to insurance, right? You don't need it until you need it. You don't want it until you need it, I guess. And so establishing those relationships early, kind of letting those folks know that these are the types of investments you'll be investing in. Here's where I think I might need your help and what timeline, because it makes for a smoother process for everyone. I think interim testing is something that is helpful, where you can kind of review portfolios, whether it's even just a positive assurance where we're looking at your methodology that can help potential LPs and kind of assuade them of any concerns of evaluations, right? But I think just being open and communicative to all of your service providers at an early stage is helpful for sure. How about you? What would you provide? What would you suggest?
I would suggest they get a good data provider.
There we go. I love that. That's what I'm talking about.
Where could people go to connect with you and learn more about Houlihan?
Yeah, good question. I don't really have a public Twitter. I certainly have a pseudo-anonymous crypto Twitter account. Feel free to email me, jbrennan@houlihancapital.com, and reach out that way. And I'm happy to spark a conversation. LinkedIn as well as another spot as well. So
we'll include those in the show notes. And Joe, this has been great. Thank you so much, man.
Had a lot of fun. Appreciate it. Thanks for inviting me on.
Thank you for watching the Alt Funds Investment Podcast. As always, please like and subscribe if you find this information helpful, and let us know down below in the comments what questions you have. Reach out if you're starting an investment fund, and we can help connect you with the right service providers.